Hi everybody, my name is Justin. Today I'm doing another video on Alibaba, ticker symbol BABA. So this is a fundamental analysis and an update to my intrinsic value for this company. I've done a couple of these over the last several months, and I do think there's a lot of new information that has come out over the last 3 to 4 months that does impact the intrinsic value of Alibaba in my personal opinion. So we're going to go through and we're going to look at historical numbers, and we're going to come up with a new intrinsic value and what I believe return on investment will be for this company based on different stock prices, including the stock price it is right now. So hopefully you get some value out of this video, and let's get right into it. And so there are different financial drivers to calculate intrinsic value. So first off, we need to look at the free cash flow of the company. And the trailing 12 months, they've been at about $25 billion. So how we get to that is cash from operations of $33 billion. This is basically how much money is left over for the company after they've paid their bills, their day-to-day type operations. But we want to also add in CapEx for the company, or subtract that out from cash from operations. And that was about $8 billion. So in total, or the difference between the two is that $25 billion. So that's how much the company has left after paying all their bills and paying for all the equipment necessary to keep this business running. Next up, we need to talk about the impact of Alipay. So we knew since April that the government wanted to split up Alipay. We just didn't know what the specifics of that are going to be. So recently we found out what that is going to be, and they're going to divide it into 3 different entities. So Ant Financial, which owns Alipay. Keep in mind that Alibaba owns 33% of Ant Financial. So Ant Financial owned all of Alipay, but going forward, Ant Financial is going to own about 35%. This investment group right here is going to own another 35%, and the difference will be made up by the Chinese government. All right. And this is really important because Alipay, 33% of the revenue and profits flow down to Alibaba previously. Since Ant Financial owns less piece of the pie for Alipay, that means Alibaba is going to get less. And so we need to figure out how much less that's going to be. What is the impact on the revenue and the bottom line, so we can calculate a new intrinsic value for the company. And when I went back and I looked, Ant's revenue for 2020 was roughly about $10 billion. And 36% of Ant's revenue was Alipay. So if I look at that, I'm going to say Alipay was roughly $3.6 billion for Ant Financial. All right. So now with the new setup with Ant Financial owning 35% of Alipay and not 100%, how I'm looking at that and saying, okay, well, Alipay's revenue was, around $3.6 billion. If Ant Financial owns 35% of that, roughly $1.26 billion will be coming back to Ant Financial. Now, what is the impact to Alibaba? Since Alibaba owns 33% of Ant Financial, roughly that's going to be about a $400 million impact to Alibaba on an annual basis. So I get to about 1.6% impact to Alibaba's revenue and bottom line. And not only that, but I'm just going to round, I'm going to say roughly 2%. I'm trying to make this as simplistic as possible. So I'm just going to say about 2% of Alibaba's revenue, earnings, free cash flow is going to be impacted. So we're going to see 2% less going forward when I calculate intrinsic value. All right. So we also need to look at a couple other factors here too as far as intrinsic value. And the first one is the $15.5 billion donation that Alibaba ended up paying to the government. So this went to the Common Prosperity Drive that President Xi Jinping of China wanted a lot of these large companies to put money into. So we saw Tencent, we saw Alibaba, Pinduoduo also put money towards this. And the idea here is that they're kind of doing a wealth distribution, trying to move money from companies that are very wealthy, people that are wealthy, to kind of the lower level people. And the reason for that is over time, they're trying to build up their middle class. Keep in mind, there are things around 1.2, 1.3 billion people in China, largest population in the entire world. And if you look back 20 years ago, only 80 million were in the middle class, and they're estimating around 800 million are in the middle class right now, and that is continuing to grow. And this common prosperity drive is going to hopefully push more people into the middle class. At least that's what the Chinese government is trying to do. Now, this donation is going to be paid over 5 years, so it's not just a one-time, it's over a 5-year period. Part of this valuation, I'm going to assume there's no additional donations. We'll see what happens, but I'm going to assume no additional donations after the 5 years. We also need to factor in that $2.8 billion fine that the Chinese government made on Alibaba in the first quarter for monopolistic type approaches, essentially pushing consumers, or at least trying to push consumers away from JD.com specifically, back to only using Alibaba. So the government ended up fining them for $2.8 billion. So in this scenario, I'm adding the $2.8 billion back to free cash flow, assuming this is a one-time event. All right, and that there's going to be no additional fines going forward. Obviously, these are big assumptions, but these are assumptions that I am making. And then I'm also assuming no share buybacks. Now, keep in mind, you know, the company does have a share buyback program. They have bought some shares back, but they haven't done that very aggressively. And I just don't think they're going to do much of it going forward. If they do, I don't think it's going to be a big impact to the shareholder. And so I'm just going to assume no share buybacks in this intrinsic value calculation. All right, so as far as valuation input, so I want to look at historical numbers to try to determine what it's going to be going forward into the future. Because if you look at analyst expectations right now, you go to Yahoo Finance or anywhere else, analysts don't think Alibaba and a lot of these Chinese companies are going to grow on the bottom line. I think Alibaba, they have tagged at like a 4% growth over the next 5 years, which is absolutely crazy, because management has even come out and said that they're supposed to grow 36% for 2022. So I'm not going to go off analyst expectations. I think there's just too much fear and uncertainty and doubt going on that's really pushed down analyst expectations. So we're going to look at some historical trends here. The first one we're going to take a look at is going to be the PE trend. So I want to see where the price to earnings ratio has been over the last several years and see where it is now. I also want to look at the Inquirer's multiple trend. This is something recently I've been started to do. And I've seen different variations of Inquirer's multiple, that is enterprise value over EBITDA, at least that's how I'm using it. Another one I am going to take a look at is growth trend. So I'm going to look at a 7-year growth trend for sales per share, earnings per share, free cash flow per share, book value per share. So why I'm using a per share basis on all of these is that if you're looking strictly at sales or earnings, free cash flow, book value, but you're not looking at how many shares a company is buying back or issuing, it can basically take away what you might be looking at from a shareholder value. So if a company is, you know, just doing a lot in sales and earnings and free cash flow, but they're issuing a ton of shares, that doesn't really help out the shareholder. I understand if they're a really small company and they're growing, sometimes they have to do that. But a company like Alibaba, for instance, shouldn't be issuing a lot of shares because they have so much free cash flow. So we want to take into effect how many shares they're buying back or issuing, and that's what we're going to be doing here. And then lastly, we're going to be looking at management trends. We're looking at ROIC, ROE, which is return on invested capital, return on equity, and then how much long-term debt payoff they have versus their free cash flow. So let's get right into this. And the first one we're going to take a look at is price to earnings. And you can see it's been all over the place. I mean, back, several years ago, you're talking around 55. It dropped all the way down to looks like 15 back in 2015, jumped back up, down, and today we're trading below 20. So from a historical standpoint, the P looks very, very interesting right now. It's indicating that it is of great value. And I would say historically, the company really, I would say, should be trading between 35 and 40 based on the type of growth that they have had. But as you can see, it's trading right now below 20, which could be a good indication for value. Next one I want to take a look at is Inquirer's multiple, and that's looking at enterprise value over EBITDA. Enterprise value is essentially market cap and then factoring in cash and debt as well to the market cap, and then EBITDA is earnings before interest, taxes, depreciation, amortization. And how you know if a company could potentially be of great value. If their acquires multiples under 5, that can indicate that the company is of good value. If it's under 3, that can indicate that's great value. And acquires multiple has actually beat a lot of other strategies, including the magic formula, over the last 10 plus years. All right, so if we take a look at this, you can see that it's been going down. So you're talking, several years ago around 8, and then you're looking at today, it's around 2.5. So it's under 3 right now. And I would say historically, it's kind of been around the 5-ish range. So kind of around here, I would say, has probably been average. But certainly dropping below 3, that's another indication that is of great value today. All right, so the next one I want to take a look at is sales per share. And we want to see this going up, and we do. I mean, it's gone from about a little under 5 back in 2015 to $43 for sales per share here. So that is tremendous growth. If we look at earnings per share, we want to see that kind of same trajectory, and we do. So we have 1.5 EPS here to 8.4 EPS. So that is tremendous growth as well. If we look at free cash flow per share, and keep in mind, so free cash flow per share, and the next one we'll take a look at is book value per share. These next two are my favorite two to look at. All right, so free cash flow per share, we've also seen it going up from 2.1 up to 9.2. And the reason why I like free cash flow so much is it looks at the income statement or the P&L and removes all the non-cash adjustments from that to basically give us a really good idea of really the cash inflows and outflows of the company, where there can be more manipulation going on in the income statement by management by them doing certain things, and the free cash flow removes all those potential non-cash adjustments. So that's also really good to see. This is going up in a nice trajectory as well. Look at book value per share. So book value per share is equity, assets minus liabilities. It's kind of how the balance sheet works. And you want to see this going up as well. And what this typically indicates, and you can see it go from 10 book value per share up to 63. It's incredible. It's like a 6x over the last 6 years. And really what this is indicating, the assets are growing 6 times as much as potentially what the liabilities are. Now that doesn't always mean the case, but in this particular case for Alibaba, it does. So the assets are growing tremendously, which is fantastic. And keep in mind, since book value is equity, if the company were to go under and they sold all their assets off, paid off their liabilities, what would be left over is equity of the company or book value, and that's would be going to the shareholders on that. So next thing I like to take a look at is really management effectiveness. How well is the company running the company? And we can look at different factors. So we can look at ROIC, which is return on invested capital. Essentially, that is net income over capital, which is debt financing and shareholder equity. So essentially what I want to see here is a 10% rate. So what that would tell me is every dollar put into the company, whether it's debt financing or shareholder equity, 10 cents of that is turned into net income. So if they can be over 10%, that indicates the company, or at least management, is very effective in turning their equity and capital into net income. And we can see they've done an excellent job. I mean, they've been got 12%, 23%, and then they've been really between 11 and I guess, 11, 12, 15, 11. So that's pretty consistent. So the return on invested capital for the company has been very, very consistent, done really well. ROE, which is strictly looking at shareholder equity only, also looking really good, 15% to 13%. So all those are over 10. So that is a really, really good indication management is very effective in managing their money. Last thing I want to take a look at is long-term debt payoff. And what I'm doing here is I want to see if the company can pay off their long-term debt less than 3 years based on their free cash flow. And they certainly can. I think they have around $20 billion of long-term debt, which sounds like a lot of money. But keep in mind, they had 25 billion of free cash flow over the last trailing 12 months. So if you look at 6 years ago, it was 1.5 years to pay off their debt, and it's been going down. So they've been doing a good job paying down their long-term debt. And right now it's under a year. So that is fantastic. All right. And so what we want to do now is look at some, different growth and management effectiveness numbers. So the numbers that we just looked at are those charts. I want to break those down and say, okay, what is the growth rate? What is the CAGR, the annual rate that these metrics have grown per year? And we can, and so that kind of gives me a good idea, what the company is doing. And what I like to look at specifically is these growth metrics: sales per share, earnings per share, free cash flow per share, book value per share. I want to see them growing 10% per year over the last 7 years. And if we look at the first one of being sales, it's grew 42%. That is well over 10%. Earnings per share, 33%. Free cash flow per share, 31%. Book value per share, 35%. That is tremendous growth. So this company, even though it's close to $500 billion market cap, the growth that this company is producing is absolutely incredible. It's hard to find in this market anywhere. All right. I mean, if you look at Facebook, you look at Microsoft, Apple, as great as those companies are, they don't have these type of growth rates that Alibaba is putting out. So all these are yeses. They're well over 10%, which is fantastic. If we go down to, management effectiveness down here, we're looking at ROE, ROIC. I want to see over those 10% average per year, 17% ROIC, 14%, 17% ROE, 14% ROIC. And so those are both yeses there. And then as far as long-term debt payoff, I want to see less than 3 years on that. We're seeing less than a year. So that's also yes. So all 7 of these are yeses. So that is a good indication this company is growing at an incredible rate, and the management is very, very effective at managing their money and bringing value to the shareholder. All right. So next thing we want to take a look at is valuation. So we want to try to figure out what the intrinsic value of this company is. And in order to do this, let's jump over to my discounted free cash flow model, and we'll take a look at what I am valuing this company at right now. All right, so now we're over at my discounted free cash flow model, and I'm just going to explain these numbers just real quick. So first off, I'm trying to calculate a growth rate over the next 10 years. So keep in mind that we were seeing, the growth rates. If we go to my summary page here, we can see the growth rates of free cash flow per share of 31% over the last 7 years per year. So I'm actually being, I think, pretty conservative on this valuation. I'm saying 20% growth the next 3 years, 17.5% growth rate 4 to 6 years out, 15% growth rate 7 to 10 years out. So well below that, 31% that the free cash flow has been growth rate wise over the last 7 years. Discount rate 25%. I know that's really high. I'll explain why here in a second. I'm using that number. Multiple, I'm using a 15. I've done other videos where I've used even a 20. Trying to be really conservative here. And so I'm just using a multiple of 15. You certainly could use higher one than that if you wanted to. I mean, we saw that the average really P ratio for Alibaba has been, anywhere from 35 to 40. But again, just trying to be conservative here. Earnings or shares outstanding right now around 2.7 billion shares. So free cash flow, I'm using that 25 billion, which is the cash from operations minus capex, but I'm adding back in that one-time fine that the company had in the first quarter. So that's why I'm having 27.5 billion here. Now, net debt. So if it's a negative, that's actually a good thing. So keep in mind that net debt is total debt minus cash. So if cash is greater than what total debt is, that means it's going to be negative. So it indicates here that Alibaba's cash is actually more than what their long-term or total debt is on their balance sheet or on their books. All right. Now I'm trying to factor in these two things down here. So one, I'm factoring in common prosperity donation. So what I'm doing here is I'm actually decreasing the total cash on the book. So actually total or net debt for Alibaba is a negative $45 billion. And so what I'm doing is I'm adding this common prosperity, 15.5 billion into that, saying that's going to pull from the cash over the next 5 years. So I'm actually reducing, cash, increasing or increasing debt, I guess, depending on how you look at it. So that's what's getting down to this negative 29 billion in net debt here. Now, as far as the 2% Alipay adjustment, what I'm doing is I'm actually adjusting free cash flow down by 2% going out the next 10 years based on what I project is the decrease in free cash flow for the company that with the breakup of Alipay and with Ant Financial. So if we do all that, I come to an intrinsic share price of 165. The reason why it's 165 and going back to that 25% discount rate, what that is indicating right now is if all these factors, the inputs are correct, and this is what plays out the next 10 years, and Mr. Market kind of abides what I have here, you'd have a 25% rate of return per year over the next 10 years, which you mean your total shares, your total value that you put into the company would grow double essentially every 3 years, which would be absolutely incredible. Now, if you were to say, you really should be using, 15%, Justin, for discount rate. So if I use a 15%, discount rate on my required rate of return or IRR, that'd be around $310. And so what I'm trying to show here is even with the Alipay deduction of 2% going forward for free cash flow, even paying that $15.5 billion of donation to the Common Prosperity Drive, the intrinsic value of the company is still looking really good. The impact is actually fairly small to Alibaba because it's so big. Their free cash flow is so high. And what I also wanted to do next is trying to figure out, based on what you purchased the stock at, what could your ROI, your return on investment, be or expected to be for this company based on these inputs? Because I can tell you right now, my cost basis for Alibaba is not $165. Unfortunately, it's in the low 200s. So for me, I'm not expecting a 25% rate of return per year for Alibaba. It's going to be less than that. Whereas if you bought below 165, you can expect more. So let's go back to my earnings presentation here, and let's take a look at my valuations based on different stock prices. All right, we're back to my presentation right now, and so let's talk about valuation summaries based on price of the stock that potentially maybe you bought into or maybe the future price it may be. And so if we take a look at this, like I said, based on prices right now, so the stock's trading around $161 today. Close of the market yesterday was October 8, 2021. So based on my inputs, I would expect around 25% ROI. Now, if you bought in around 125, it hasn't reached down to $125, but if that were to be the case, that'd be around a 30%. If your buy price is around $220, I would expect a 20% return over the next 10 years. $300 would be a 15% rate of return per year, and then $400 would be around a 10% rate of return per year. So based on this, I think my cost basis is around like 206, 207 right now, something like that. I would expect probably around 22%, something like that going forward. If my inputs are correct, and I'm not a financial advisor, this is just how I'm looking at it. What my opinion is, you should be doing your own valuation and digging in due diligence of your company. Don't just depend on somebody on YouTube to do your valuation. You should do some on your own as well. So the next thing I want to take a look at and really people should be aware of is all the risk associated with this company. It wouldn't be fair for me to do this fundamental analysis without talking about the risk associated with Alibaba and buying into them. So first off, we got to look at how this company is kind of transforming itself going forward. And this is a huge thing people don't talk about. And this is the cloud that Alibaba is putting together. So keep in mind, as far as the cloud company, cloud-based revenue that they're going to be bringing in, right now it's about 10% of Alibaba's total revenue. They're the third largest cloud company in the entire world. And I think eventually they could be the #1 player in the entire world, just because China is the biggest economy in the world. So that is not impossible for them to do. And they're the biggest one in their space in their country. And so keep in mind that it costs a lot of money, a lot of CapEx to put this infrastructure in place for cloud. So by doing that, it's going to create really, basically it's going to decrease their future free cash flow. And that's why I was decreasing it going out. Now, I do think they're going to have it built out over the next 5 to 7 years, so maybe their CapEx won't be as big at that time, but we're going to see more capital expenditures on their books going forward. Another thing is, there could be additional donations going on, Who knows what the CCP is going to do? Maybe there's another additional fines. That could be potentially as well. I certainly the fines, I think, is pretty small chance that that's going to happen. Donations, who knows? Who knows what that? Another thing is, will the CCP break up BABA any further? And I'm mostly talking about Ant Financial here. They haven't broken up BABA specifically, but obviously they broke up Alipay, which affects Alibaba. Are they going to do any kind of breaking up more of Ant Financial or anything with Alibaba? There was talk of maybe breaking up Alibaba and Tencent and making a big conglomerate. I highly doubt that would ever happen, but who knows? Another thing is, will the CCP pull the VIE structure so that way people, shareholders in the United States or other areas outside China can't buy these companies? I think it's unlikely that's going to happen, but that's certainly a risk. Delisting of Chinese stocks by the U.S., that is also a potential. I think that's also unlikely. I think these two things kind of go tied together. I think these are kind of pushback from both governments, from China and the U.S., saying, hey, trying to get their own way. And eventually, I would hope that both countries, both political regimes look at it and say, we really need each other to grow. I think it would actually hamper both countries if they would not play well together. And ultimately, I think it's the investor's responsibility and their own risk if they're going to invest in a company like Alibaba or Chinese companies in general. I know there's been people that have been burned by Chinese companies like Luckin Coffee, for example, but those are the risks you need to assume going in, and don't put any more money into it than you are not willing to risk. And it's even more risk putting into Chinese companies, in my personal opinion. So it's certainly a risk. Another thing is political risk. I mean, obviously there's tariffs still out there from the U.S. government to China. Biden has talked about wanting to lower those, but they're certainly out there. And then also, what about defaulting on current policies? We know right now that China is not buying as much product and produce from the United States they're supposed to be doing, including pork, and there's definitely debate on there. Has the middle class grown enough to be able to support that type of policy, or is China just saying, oh, we don't care about sticking to that policy? Obviously, we've heard recently that Biden and Jinping are actually going to talk in December, so I'm sure some of the stuff is going to come up. But these are certainly all risks, and these are just some of the risks. I mean, there's more than that, right? This is enough risk as it is, but there's certainly others that are out there, but certainly need to be considerate looking at this and other Chinese stocks, certainly. So that's what I wanted to cover in this video. Hopefully you guys got some value out of it. If you haven't already done so, please like the video if you got some value out of it. If you like this kind of content, I encourage you to subscribe to my channel. I try to produce as many videos as I can out there. Alibaba is my largest position in my portfolio. I do different stock analysis on different companies that I find interest with. Check out my channel if you can. Thank you so much for watching. I really appreciate it. I'll catch you guys on the other side. Take care and God bless.